All right, so in our last class, we discussed the introduction to cost of capital. We talked about the importance of cost of capital and then the categories of cost of capital. As a way of recap, let's spend about a few minutes just to refresh our memory on what we did in our first day lecture, particularly for those that are just joining us for the first time. All right. So last week we started with cost of capital, and then we said that the cost of capital is the compensation required by the providers of capital from their investments in a company. And then the cost of capital usually is determined by the market forces of demand and supply, depending on the perceived risk associated with a company. All right. Then we moved on to discuss the importance of cost of capital. And we said that the significance or the usefulness of cost of capital cannot be overemphasized, particularly in the determination of optimal capital structure of a company. Essentially, we said that there are two key importance or significance of cost of capital. One is project evaluation or investment appraisal. We said that in the determination of financial viability of a project, cost of capital will be needed to discount the expected future cash flows to the present value equivalent using relevant investment appraisal techniques such as the net present value, internal rate of return, modified internal rate of return, or even adjusted present value, and that it will be almost impossible to ascertain the financial viability of a project without the use of a cost of capital. Number two, we said that uh, another significance of cost of capital is determining debt equity proportion. In the capital structure of a company, we say capital structure is the way and manner that a company finances its operation. Majorly, there are three key sources of long-term financing. One is ordinary share capital, two, preference share capital, then three, debt capital. Each source of finance has its own underlying cost. So the objective of the company is to minimize the overall cost of the capital to a firm. Therefore, the cost of capital will enable a firm or a company to be able to determine the proportion of equity and debt to be carried in the capital structure. So in order to minimize the overall cost. All right. So these are the two key importance of cost of capital. After this, we proceeded to discuss the categories of cost of capital, and then we said that cost of capital can be grouped into three. One is traditional weighted average cost of capital. Two is project-specific cost of capital, and then three is the weighted average cost of capital of the combined activities. We said that on the day of your exam, you will just be asked to calculate cost of capital. Examiner will not tell you whether it is traditional, project-specific, or WACOCA. So the onus is on you to be able to deduce or to infer from the question the kind of cost of capital the examiner is expected you to calculate. So we started with traditional weighted average cost of capital. And we said that traditional weighted average cost of capital is computed when information about capital structure, such as ordinary share capital, preference share capital, and then debt capital, including dividend and then interest, are given in a question. If you go to the statement of financial position of a company or you go to where you have information about the capital structure under the financed by, you can see if you can see ordinary share capital, you can see preference share capital or debt capital. Then you go to the statement of profits or loss account. You are seeing the dividend information. You are seeing information about interest. Then, and you are asked to calculate cost of capital. You need nobody to tell you that this is weighted average cost of capital using the traditional ways. All right. So that is as per that. We then said that, okay, calculating cost of capital using the traditional or calculating traditional weighted average cost of capital. There are four key procedures you are expected to carry out. The first step is to calculate cost of equity. Step two, you compute cost of preference share. And then step three, you determine cost of debt. Then step four, you estimate weighted average cost of capital. That is the maximum steps that you are going to carry out anytime you want to compute traditional work. I also mentioned that it is possible in a question, examiner may not give to you preference share because preference share has the attributes, okay, attributes of equity and debt, okay, attribute of equity in the sense that the price can appreciate, okay, the price can appreciate. And then the attribute of debt is that the preference shareholders are entitled to fixed dividend. So you may not have preference share capital in the question. You may just be given ordinary share capital as well as a debt capital. So in this case, you are going to carry out only three steps, okay? Only three steps to calculate your traditional work. So we now started with the first procedure, which is to estimate cost of equity. We then said that cost of equity represents the minimum required rate of return expected by the ordinary shareholders from their investment in a company, and it is also known as opportunity cost of capital. Okay, we then say, how do you estimate cost of equity? We said there are three methods of calculating cost of equity. One is using dividend valuation model, two, capital asset pricing model, and then three, Miller and Modigliani preposition, okay, formula. All right, so these are the three methods or three ways in which you can estimate your cost of equity. We started with the dividend valuation model. We said that dividend valuation model should be used to calculate cost of equity when information about dividend and share price are given in a question. And we said that using dividend valuation model, cost of equity is computed as the ratio of dividend to share price, depending on whether dividend will remain constant to perpetuity or dividend will grow. So I gave you two different formulas that you can use to estimate cost of equity using the dividend valuation model. Thereafter, we move to discussing the concept of cum div and ex div share price. We said that cum div share price is the share price that includes dividend, whereas the ex div share price is the share price that excludes dividend, and that in the determination of cost of equity, only the ex div share price is used. Where cum div share price is given, then you need to convert it to ex div share price before you compute the cost of equity. Then lastly, we talk about how to estimate growth rate because we believe that ordinarily shareholders or investors will expect that the dividend earned in a company will grow over time. No shareholder will expect to earn the same amount of income, so the same amount of dividend income every year because of prevailing market condition or inflation, for example. All right. Therefore, it is expected that the dividend income a company will receive in a company will grow, will increase over the years. Okay. So then say, how do you estimate the growth rate? I gave you two different methods. The first method is using historical pattern of dividend payment, which is also known as averaging method. We said that ideally, the historical pattern of dividend payment should be used when past information or when history about dividend payment are given in the question. When you are given about the dividend paid in the previous years, or you are given information about dividend, then it means that you are going to calculate growth rate using the historical pattern. I gave you two different formulas. Depending on the information available, either of the two formulas will be used to estimate the growth rate. Then the last one is the Gordon growth model. And we said that the Gordon growth model should be used to compute growth rate when information about earnings, that is profit after tax, and then the capital employed are given in a question. This is where we stopped in our last class. And of course, we tested about three different worked examples, small example, just to test the principle. All right. That, and I mentioned to you those questions that we solve, they are just to explain, they are for explanation purpose. At this level, that's not the kind of question that you are going to see on the day of your exam. All right. So right now we are going to solve one more. We are going to solve one more example under the cost of equity before we now move to cost of preference share. All right, let me know if you have. This is what we did last time. Let me know if you have any question. If not, I will just move straight to solving one more examples just to test additional principle that we have discussed so far before we then move to discussing cost of preference share. 1 minute, any question? If not, let's go ahead. So when you see me writing, just writing jaga jaga on my screen, it's because I don't want my pen to stop working. Because if I pause for too long, it will stop. I have to go out and come in again. All right then. So let me. I don't know. Let me see if you can see my screen. The question is not in this material. Let me see. Can you see the screen I'm sharing? Let me call one of you. I want to know.
Yes, sir.
Faith, what are you reading on my screen? What do you have there? I want to see if you can see the material I'm sharing.
Milan Modigliani.
Can you see capping is a topic and will be treated in detail in subsequent chapter?
Yes, sir.
Okay, then since you can see, no qualms. In that case, let's move on. I want to give, like I said, I want to give you one more example under the cost of equity. Okay, so I will screenshot this, then okay, let me just share it because I know some people will be asking me, where do you see this question? Where is this question? It's not in my material. Let me just screenshot and share. When you know your people, you have to behave like them. I don't want any disruption. So let me quickly do what I need to do. And I've closed my WhatsApp up. Let me go back. SFM. Okay. Yeah, land. All right. I believe so. Go to the SFM group, go and pick the question there. All right. Morino PLC is financed entirely by equity. The company has 150,000 ordinary shares of 1 naira each, currently quoted at 3 naira 42 kobo. That's the share price. The company's current dividend of 6,158 naira was paid recently out of the company's earnings of 62,858. So I can see information about earnings. Okay. Capital employed of the company is 315,000 naira. Okay, I can see capital employed, so which means that we are likely going to calculate growth rate using the Gordon growth model. And a dividend of 2,473 naira was paid 5 years ago by the company. I can also see the history of dividend payment 5 years ago. Okay. So in this case, since I'm given dividend paid 5 years ago, I'm also given current dividend of 6,158. It means that I'm going to calculate growth rate using the historical pattern. Finally, required. What is the company's cost of equity capital? You see, this is what I just said. Shebi, I told you I know my people. Somebody is asking me, what page is this? Please let me answer the person so that we can progress. Go to your SFM group, you will see it there.
Hello, sir.
All right.
Good evening, sir. Hello,
Who is
sir.
speaking? Bukola?
It's Bukola, sir. Sir, I'm just joining. I didn't have the material. I don't know how I can get it.
Okay. Next time, if you want to talk, just raise your hand so that we don't disrupt the class. The question we are solving right now is I've just shared it in your SFM group on your WhatsApp.
Okay.
So pick it from there. All right?
Okay, sir. Yes,
Yeah.
sir.
Okay, then. So we want to calculate cost of equity. Like I've explained, in this question, you are given information, okay? You are given information about the current dividend, information about dividend paid in the current year, which is 6,158 naira. You are also given information about dividend paid 5 years ago. So which means that we are going to calculate growth rates using the historical pattern of dividend payment. Secondly, in the first paragraph, examiner has given information about profit after tax, that is earnings, to be 62,858 naira. So also, you are given capital employed to be equal to 315,000 naira. Since you are given information on earnings as well as the capital employed, it means you are going to calculate growth rates using the Gordon growth model. So in this question, examiner has given all information about historical pattern of dividend payment. You are also given information about Gordon growth model. So it means that you are going to calculate two different growth rates. So if you calculate two different growth rates, it is expected that you are also going to calculate two different cost of equity. Let me repeat this information. In this particular question, examiner only asks you to calculate cost of equity. You are not told to use either Gordon growth model or historical pattern. The information you have in the question will tell you the direction that you should follow. So as far as this question is concerned, examiner has given us information about the current year dividend to be 6,158 naira. We're also given information about dividend paid 5 years ago to be equal to 2,473 naira, which means we are going to calculate growth rate using the historical pattern of dividend payment. In addition to this, examiner also told us in the first paragraph that the earnings of the company is 62,858 naira. Examiner did not stop there. You are also given capital employed of the company to be equal to 315,000 naira. Therefore, it means that we are also going to calculate another growth rate using the Gordon growth model. So, since you are calculating two different growth rates, that means you are going to calculate two different cost of equity. So, this is what you need to do in solving this question. So, again, I need you to, if you go to your SFM page, WhatsApp group, you will see the question I've shared before I started uh, reading the question. So please go there and pick it. All right. Okay then, so let's solve the question together. Let me switch to the working notes so that I can use it to demonstrate for you how you are going to do it. Okay, the name of this company is Morino. Morino PLC. What do you want to do? Examiner wants us to calculate our cost of equity. Remember what I told you last week. It is expected that what we are doing now is expected that you have done it under financial management. I'm supposed to be moving at a faster rate, but I believe I understand that there are some students that jumped fence. Okay, there are some students that jumped fence because in that case, or uh, last diet, that's about few months ago, like 4 months ago or thereabout, even 5 months ago, you might have forgotten some of these concepts, and that's why I have to take it to ensure that you understand it. So I don't need to be moving at a faster pace. I need you to understand the basics. You need to understand the reason why we are doing it the way we are doing it, so that when you see it in a bigger question, no matter how voluminous is the question, since you understand the basics, since you know the fundamentals, you can't do no wrong. Okay, you cannot do any wrong. You are going to get to the right answer. All right, just all you need is for you to read, understand it in the class, go and practice it on your own. All right, so let's go solving this question. So examiner is asking us to calculate cost of equity. So I need to indicate what I want to do. So I will then say calculating cost of equity, denoted as KA. So how do I calculate my cost of equity? Last week I gave you two different formulas. The first formula where there is no growth in dividend payment, the second one where there is growth in dividend payment. In this question, we have identified that there is growth in dividend payment. Why? Because we are given information about historical pattern of dividend payment. We are also given information about the Gordon growth model. Since we have identified that there is growth in dividend, therefore, our formula will then be cost of equity equal to the current dividend multiplied by 1 plus the growth rate over x dividend share price, then plus the growth rate, all of this multiplied by 100 over 1. All right, so this is the formula for calculating cost of equity when there is growth in dividend payment. So since we have identified that there are two different uh, growth rates that we are going to calculate, so I can then come here, number A, using historical pattern, okay, of dividend payments. So if I'm using historical pattern of dividend payment, remember I told you last week that historical pattern of dividend payments is used for calculating growth rate when the history or when past information about dividend payments are given. When you are given information about dividend paid previously and the current, so it means that you are going to use the historical pattern to calculate your growth rate. So using the historical pattern, I gave you two different formulas. The first formula is when information about dividend paid for across all the relevant years. If you have year 1 to year 4, when you are given information about dividend paid across all the 4 years, that means you are going to use the first formula. And you know that the first formula is n minus 1 into square root latest dividend over dividend paid in the first year, all minus 1. That's the first formula. The second formula is used when information about the first year dividend and the current year dividend are given. And the formula is n into square root latest dividend over dividend paid in the first year, all minus 1. So when you look at the information given in this question, you will see that examiner has given us amount of dividend paid 5 years ago. We are also given information about the current year dividend. That means we are going to use the second formula to calculate our growth rate. So I will then come here. I need to go and determine the growth rate. So this page will be for historical pattern. The second page will be for Gordon growth. Then the third page will be for our workings. You see the way we are doing it, you don't mix working with the main calculation, because you as a professional, you are seen as being representing the institute. You are seen as being representing your firm, and you are also seen as you are defending a proposal with your client. Therefore, nothing short of a professional is expected of you. You are supposed to analyze, you are supposed to provide that professional judgment for the benefit of your firm. All right. So, and that's what I said, nothing short. At this level, this is the final level. Nothing short of a professional is expected of you. All right. Okay. So, workings. Working number 1, calculating growth rates using calculating growth rates. Number A, using historical pattern. Okay, using the historical patterns. So we have identified that we are going to use the second formula because we are given information about the current year dividend and then the dividend paid 5 years ago. So in this case, my growth rate will be equal to n into square root latest dividend. Let me redraw that. Latest dividend over dividend paid in the first year, all minus 1. Okay. Alternatively, I can say latest dividend over dividend paid in the first year, all raised to power 1 over n, all minus 1. It's the same answer we get. All right. So anyone that is more convenient for you. So I can then say the growth rate is equal to, we then go back to the question. Let's go back to the question. We want to calculate growth rates using the historical pattern of dividend payment. If you like, I can go to the question. Of course, the company's current dividend of 6,158 naira was paid recently. That means the share price given to us of 3 naira 42 kobo is ex-div. So my current dividend is 6,158. All right. So here is my LD. Remember, latest dividend or current year dividend, that's the LD. LD is equal to 6,158 naira over dividend paid in the first year. So the dividend paid 5 years ago is 2,473 naira. Okay, then raised to power n is 5 because 5 years ago. So n is equal to 5. Therefore, raised to power 1 over 5, all minus 1. Then we get the final answer. So bring out your calculator. This is the way you are going to do it. Of course, I know that 1 over 5 is equal to 0.2. All right? From your calculator, 1 over 5 is equal to 0.2. You then you just say 1 over 5 equal, it will give you 0.2. You leave it as it is. Then you open a bracket to say 6,158 naira divided by 2,473 naira, close the bracket, raise to power answer. You get the final answer, right? That's what you need to do. All right. So I will say 6,158 divided by 2,473 equal then raised to power 0.2. I've already So this will give me 1.200 whatever, then minus 1. So that's 0.20, then multiply by 100%. 20% is the growth rate using the historical pattern. Here is 20%, okay? So cost of equity using the historical, growth rate using the historical pattern is 20%. So let's quickly calculate for Gordon growth. So number B, using Gordon growth model, okay? So using the Gordon growth model, I told you that Gordon growth model is used to compute growth rates when information about earnings and the capital employed are given in a question. All right. So in this case, growth rate will be computed as return on capital employed multiplied by the retention rate. All right, let me write it out. R equal to return on capital employed, then B equal to retention rate, all right? So that's that. So what that means is that we need to go and estimate return on investment as well as the retention rate before we can complete our calculation on the growth rate. So R will then be equal to earnings over capital employed multiplied by 100%. Okay, so R is equal to, according to the question, how much is our earnings? Charity, are you there? Or Faith, give it to me. How much is our earnings in the question? I don't want to be switching.
62,858.
62,858. That's the total earnings divided by capital employed. How much is capital employed?
315,000.
315,000. All multiplied by 100%. Give it to me. What's the final answer?
20%.
20% is the return on investment. 20% is the return on investment. Then B is the retention rate. So retention rate is computed as earnings minus total dividend, total earnings minus total dividend over total earnings. Multiply by 100%. So in this case, my retention rate will be equal to total earnings is 62,858 naira minus how much is total dividend?
6,158.
The total current dividend is
Okay, 6,000.
6,158. Okay, so over total earnings of 62,858, all multiplied by 100 over 1. Give it to me. What you get?
I think 91%.
Yes. 62,000. Pardon?
91%, 90.5. Someone should confirm.
90%.
Okay. 90.5.
90%.
Okay.
Are you sure it's 90.5?
Yes, 90.59.
It's not up to that. It's 90%.
90.2.
You know, 62,858. Hold on. 62,858 minus 6,158 equal divided by 62,858 equal
Oh, okay.
multiply by 100%.
It's 90%.
That's 90.2. It's approximately 90%. So now that we have computed the return on investment to be 20%, we've also computed the retention rate to be 90%. Therefore, growth rate will be equal to, we said it is R multiplied by B, that is return on investment multiplied by the retention rate. So G will then be equal to 20% multiplied by 90%. So this will give us 18%. The growth rate is 18%. So using Gordon growth model, growth rate is equal to 18%. You can see we want to calculate cost of equity, but because we know that we are going to need growth rate, then we need to go and do our working first before we go back to the main page of our answer booklet. So in this case, I will then come here using the historical pattern. The growth rate will be equal to, we are using formula, in our formula, DO is the current dividend. According to the question, current dividend is 6,158 naira. When you look at the information given about the current dividend, you notice that the current dividend is absolute value, right? Because you are given total dividend of 6,158. But the share price that you are going to use, the ex-div share price you are going to use is in par value. So the ex-div share price is 3 naira 42 kobo. You cannot use the numerator to be absolute value, and you are using par value for the denominator. So you have to give apple for apple. So it's either you want to use absolute value or you want to use par value. So I will demonstrate the two for you. I will use both the absolute value and then the par value. Anyone that is more convenient for you is what you should use. But on the day of your exam, please, if you have this kind of information, don't go and be demonstrating so much skills because you know so much. You now be doing absolute value, you then do par value, you are just wasting time. All right, don't do that. Just do anyone that is more convenient for you. So in this case, like I said, I will try the absolute, I will also try the par value. Of course, you are going to get the same answer. So my current dividend is 6,158 naira multiplied by 1 plus growth rate. We are using the historical pattern. The growth rate we calculated for historical pattern is 20%. So 1 plus 20% will give us 1.2 over the ex-div share price. You know, the ex-div share price given to us is 3 naira 42 kobo. I cannot come in and say 3 naira 42 kobo. That is not appropriate because this is a mismatch. The dividend is in total value. Your share price, you can't be using share price. It has to be the market value of equity. So in this case, I need to go and calculate market value of equity because this 3 naira 42 kobo is the market price per share. So I need to go and calculate the total market price. Okay, so let's go and do the working. That will take us to working number 2. I want to calculate market value of equity. Working 2. Market value of equity. MVE. Okay. How do you calculate market value of equity? The market value of equity is computed as number of ordinary shares multiplied by XDIV, share price. So, how much is number of ordinary shares of Morino PLC? Yes.
50,000.
150,000 shares. So here will be 150,000 shares multiplied by XDIV share price is 3 naira 42 kobo. Therefore, the total market value of equity of Morino PLC is 150,000 shares multiplied by 3.42 share price. That's 513,000 naira. Here is 513,000. Okay, so that's that. So now that you have the market value of equity, we can then continue with our calculation. So here is 513. So you can see our dividend now is in total. We have total dividend. We also have total market value of equity. So now we have apple for apple, all right? So plus the growth rate is 20%, 0.20. Then multiply by 100 over 1. So, what am I doing? So G, this is K. Therefore, cost of equity will then be equal to, let's use calculator and get the final answer once and for all. No need to be doing step one after the other, step by step. So here will be pay attention to this because oftentimes students do make mistake. At times students may say 6,158 multiplied by 1.2 plus 0.20 divided by 513,000. When you do that, you cannot get the right answer. That would be wrong. So what you are supposed to do is 6,158 multiplied by 1.2 equal, then divided by 513,000 equal plus 0.2 equal, then multiply by 100% equal. So this is 21.44. Cost of equity of Morino PLC using the historical pattern of dividend payment is approximately 21%. Okay, so that is that. Now, alternatively, remember I told you that I'm going to demonstrate absolute value and then the power value. So alternatively, if I want to use the power value, you know, my share price of 3 naira 42 kobo, of course, that's power value, but the dividend given to us is in total 6,158 naira. So if I want to use power value, it means that I need to go and convert my total dividend to dividend per share. Okay, so in this case, I can say cost of equity equal to, let's go and convert, let's go and calculate dividend per share. Working number 3, dividend per share. DPS. Okay, so dividend per share is equal to total dividend divided by number of ordinary shares, which is equal to 6,158 naira over 150,000 shares. So dividend per share will be equal to 6,158. Let me bring out my calculator. 6,158 divided by 150,000. That's 4 kobo. 0.0 0.04 or 4 kobo. So dividend per share is 4 kobo. So I can then go back to my calculation. Dividend is 4 kobo. Dividend per share is 4 kobo. 0.04 multiplied by, we are using the historical pattern. Growth rate is 20%. So that's 1.2 multiplied by 1.20, then divided by XDIV share price. XDIV share price is 3 naira 42 kobo plus the growth rate of 20%, all multiplied by 100%. So this is what I mean by using power value. So you are still going to get the same answer as 21%. Okay, so whichever one that is more convenient for you is what you should use. So like I said, please don't go and be showing so much skills on the day of your exam by demonstrating the two. When you do that, the examiner will not penalize you, but you are just wasting time. All right. So number B, using Gordon growth. Using Gordon growth model. Cost of equity using Gordon growth model. So there's no much difference. The only thing that will change is the growth rates. All right. So cost of equity, if we are using the absolute value, dividend is 6,158 naira. We have calculated growth rates for Gordon. The Gordon growth rate is 18%. Gordon growth rate is 18%. Yeah, this is the 18% here. So that will be 1.18. Here is 1.18 divided by total market value of equity, which is 513,000, plus the growth rate of 18% multiplied by 100%. Okay, so cost of equity will then be equal to, let me bring out my calculator, 6158 multiplied by 1.18 equal divided by 513,000 equal plus 0.18 equal, then multiply by 100% equal to 19.42, approximately 19%. So the cost of equity using Gordon growth model is approximately 19%. Again, if I want to use power value, alternatively, if I want to use power value, KE will be equal to, dividend per share is 4 kobo, 0.04 multiplied by 1.18. All of this divided by our XDIV share price of 3 naira 42 kobo. Then plus the growth rate of 18% multiplied by 100%. So you are going to have the same answer as approximately 19%. So that's the end of the question. That's the end of the question. You can see, examiner did not tell us. We are not told in the question to calculate cost of equity using the Gordon growth model or using the historical pattern. But the information in the question will show you the direction. Because we have information on historical pattern as well as the Gordon growth model, we calculated two different growth rates. Because we have calculated two different growth rates, we also need to calculate two different cost of equity. And that's what we have done so far. Let me know if you have any question for me. If not, we'll then move to discussing cost of preference share. Any question for me? Okay, then. So let's talk about cost of preference share. So you can open to your study material under the cost of preference share. I'll just continue with the working notes so that I'm not just switching pages. Okay, let me use this one to explain the cost of preference share. Cost of preference share, KP. What do you mean by cost of preference share? The cost of preference share represents the compensation required by the providers of preference share capital from their investment in a company. I repeat, the cost of preference share represents the compensation required by the providers of preference share capital from their investments in a company. The preference shareholders are entitled to fixed dividend in the company. The preference shareholders are entitled to fixed dividend in the company. In the event of liquidation, the preference shareholders will be settled before the ordinary shareholders, but after the debt holders must have been settled. In the event of liquidation of a company, there are priority of settlements. The debt holders are settled before preference shareholders. The preference shareholder will be settled before the ordinary shareholders. So after you have settled the debt holders, then followed by preference shareholders, the residue is what the owners of the business will take home at the end of the day from the disposal of the company's assets. This is the order of settlement in the event of liquidation. But what is important is that as far as preference shareholders is concerned, they are only entitled to preference dividend in the company. Let's say, for example, preference shareholders, let's say they invested 10 million naira in a company with the expectation of earning a return on their investment of 10%. That return on investment of 10% is the dividend that they are going to earn on the nominal value. Okay, is the dividend they are going to earn on the nominal value. The nominal value of 10 million naira is fixed. It is fixed. So the dividend or non-cumulative, all right? Participating or non-participating, redeemable or irredeemable. However, out of these three that I just mentioned, only the redeemable and irredeemable are calculation. The other ones are purely theoretical. Okay, for example, okay, let me put it down so that let me just put down a short note on this. I said this is the compensation. Let me write that. Compensation required by the preference shareholders from their investments in a company. The preference shareholders are entitled to fixed dividend. In the event of liquidation, in the event of liquidation, the preference shareholders will be settled before the ordinary shareholders, but after the debt holders must have been settled. Okay, must have been settled. That's one of the disadvantages of online. All this thing I'm writing, I don't need to write anything in the physical class. I'll just be dictating, enjoying, be moving up and down, you know. You will be the one to take the pain. The reverse is the case now. You are just relaxing. You know, some of you now, I'm very sure for those some of you that are guys, you are watching, you are watching match right now as I'm speaking to you, you know, and here I am writing for you. You see? That's good. All right then. So, yes, I also said that preference share paragraph, preference shares can be cumulative or non-cumulative. Participating or non-participating. Redeemable or irredeemable. All right. So this is what I communicated to you earlier. So now you have it. Now, let me just mention about cumulative. When you talk about cumulative preference shares, you know, this preference dividend we are talking about usually is paid out of the profit after tax of the company. You know, the top line of a company, the top line item represents the revenue. After the revenue, you charge the direct costs. You have the gross profits. You deduct operating expenses. You have profit before interest and tax. So you pay interest expense, you have profit before tax. You pay tax, you have profit after tax. Immediately after the profit after tax, if the company finances its operation with preference share capital, you need to pay the preference dividend. The preference dividend is a nominal rate on the nominal value. So just multiply the rate of return on the nominal value. So you now deduct it from the profit after tax. After the profit, after you have deducted preference dividend, then you are going to have profit available for distribution to the owners of the business. Now, what we are saying is that if it is cumulative preference share, in any year that a company makes loss, the company will not be able to pay preference dividend. So the preference dividend that is outstanding, that is the preference dividend you are unable to pay, you can carry it forward to the subsequent years until the company is able to make profits. That is what we mean by cumulative. The non-cumulative is that if a company makes loss in a particular year, we cannot carry forward the preference dividend. That means the preference shareholder will forfeit the preference dividend that they would have earned during the period. So that's just what cumulative and non-cumulative preference share is. Yes, Moses, you raise and talk to me.
Yes. Can you hear me, sir? Hello.
Moses, talk to me.
Yeah, can you hear me, sir?
Yes, go ahead.
That means
Yes,
dividend on
go
a
ahead. I can hear you.
dividend paid on preference share is disallowable expenses. If you said they are going to pay probably after tax, that means disallowable expenses. If you consider it before tax, do you get my
It's a
question, sir?
liable expense. I didn't say before tax, so I say after tax, after tax.
That means if you consider it
I didn't
before
say
tax.
before tax. I didn't say dividend is paid before tax. I said from your profit. So what happens if you consider it before? Yes, Moses. Dividend is not paid before tax now. Dividend is paid after tax. It is from your profit after tax you are going to pay your preference dividend. No be so?
No, no. I think this, I'm getting it. Maybe I'm missing it somewhere. No, we have dividend on ordinary share capital and we have dividend on preference share capital.
Yes.
Now, if you consider dividend, sometimes in school, if you saw, they will say dividend, once you pay dividend on preference share, they consider it before tax. It's allowable expenses. But if you compute
No,
dividend
no, you can't consider. No. Hold on, Moses. Don't mix
on,
it. That's not
okay.
correct. That's not correct. That's not the way it flows. Like I explained to you, from your revenue is your top line item, isn't it? In
Yes,
your statement of a profit or loss.
yes.
So revenue is your top line item. After revenue, you deduct the direct cost, right? Then you have
Mm-hmm.
gross profits. From your gross profit, you are going to less all those expenses, the operating expenses, right?
Yes,
Then you have
yes.
profit before interest and tax. So after profit before interest and tax, you must pay interest expense, isn't it? Then you are
Mm-hmm.
going to have profit before tax. Immediately after the profit before tax, then you pay tax, isn't it? So when you
Okay.
pay tax, you are going to have profit after tax. So when you have profit after tax and you have preference share capital in the equation, you must pay preference dividend first. So when you deduct preference dividend from the profit after tax, what you are going to have left is a profit attributable to the owners of the business. That is the flow. That is the flow. All right.
Okay.
Okay. So now let's talk about redeemable and irredeemable preference share. These are the ones that involve calculation. So we're starting with the irredeemable preference share. Because of time, I won't be writing anything. I can just jot. So what do you mean by irredeemable preference share? The irredeemable preference share is the one in which, let me just put it down. This is the one in which the company is expected to pay the fixed dividend to infinity, to perpetuity, but the principal but the principal will not be repaid. Okay, so what this simply means is that if it is irredeemable preference share, meaning that the capital you have contributed, you are not going to get it back. You will only be earning your rate of return every year to infinity. Let's say, for example, if a company invested 10 million naira preference share capital in another company. All right. So the preference shareholders will only receive fixed dividend every year to perpetuity, to infinity. The 10 million naira that they have invested, they will never get it back again. That is irredeemable preference shares. All right. So the cost of irredeemable preference share, the cost of irredeemable preference share is computed as the ratio of fixed dividend to ex-div share price. This is shown as follows. Okay, so anytime you want to calculate cost of irredeemable preference share, simply calculate, just say KP equal to fixed dividend divided by XDIV share price multiplied by 100%. Please note, as far as preference share is concerned, there is nothing like the dividend is fixed. All right.
Sir, sorry.
Okay, so that.
Sorry, I didn't raise up my mind. You said as long as preference share is, it was cracking. We did not hear you.
Oh, my line was cracking. I guess it's the
At
network.
that point, please repeat it, sir.
Where do you want me to repeat?
You said as long as, you said please note, as long as
Yeah, what I
ex-dividend
mean to
is
say is that preference dividend is there is no growth in preference dividend. It will remain constant. It is fixed. It's constant. There is nothing like growth. All right, that's what I said. Okay, so yeah. Then how do you, of course, I've already shown you how to calculate the cost of irredeemable preference share, which is the ratio of fixed dividend to ex-div share price. All the concepts that we discussed under the cost of equity in relation to cum div and ex-div share price, they also apply here. All right, the concept of cum div, ex-div share price applies there, which means that if the preference dividend has not been paid, it means that the share price given to you is cum div share price. Therefore, you need to go and calculate ex div share price. So that is for that. At this point, let's have a short example just to demonstrate this. All right. Let's have a short example. Let me stop sharing this and use your material to explain this. Where's your material? I think it's this one. Okay. Oh, share the wrong one. Let me see. Okay, so let's go to open to your material, go to page 29. Page 29, adding 9, illustration number 4. I believe you can see my screen, right? I'm sharing the study material. Is it? Somebody should confirm. I want to be sure I'm sharing the right material.
Yes, sir.
Yes, sir, you are sharing.
Okay. All right. Thank you. Adenine PLC has in issue preference share with a nominal value of 25 kobo. The agreed dividend of 5 kobo has just been paid. Required. What is the cost of preference share? So examiner is asking you to calculate the cost of preference share. So in this case, what are you supposed to do? All right. Of course, you can see in this question, how would you know whether this is a redeemable or irredeemable preference share? When we get to redeemable preference share, I will explain certain things for you so that you'll be able to differentiate between the two. However, this particular question is irredeemable because we are not given the redemption date. All right. Therefore, we are going to calculate cost of irredeemable preference share. So based on the information available in this particular question, I can say KP. To solve this question, I will say adenine PLC. So then calculating costs of irredeemable, we have identified from the question that it is irredeemable preference share. So in this case, KP, cost of irredeemable preference share, is equal to fixed dividend over XDIV share price multiplied by 100 over 1. It's like my network is fluctuating. All right. So KP will be equal to, I will then go to the question, how much is the dividend? We have been given dividend of 5 kobo. So here will be equal to 5 over XDIV share price. When you look at this question, we are not given XDIV share price. We are not given share price. Instead, we are given the nominal value. Nominal value is the same thing as book value. So the price can either be book value or market value. So since we are not given market value, we are only given the nominal value. Therefore, we are going to replace the XDIV share price with the nominal value of 25 kobo, then multiply by 100%. The cost of irredeemable preference share will then be equal to 20%. So that is the answer to that question. That's the answer to that question. I believe this is clear. Of course, on the day of your exam, you cannot see this kind of, examiner cannot even give to you cost of irredeemable preference share. It will be too simple, all right? It's the cheapest. It will be too simple, all right? So watch out. Now, let's go to redeemable preference share. Let's go to redeemable preference share. I'll be very happy if we can explain the concept of cost of debt today. Okay, so let's go to redeemable preference share first. I will stop sharing this and move to the working note. Okay, redeemable preference share. Okay. What is redeemable preference share? This is the one. This is the one in which the company will pay annual fixed dividend and the principal at the maturity dates. Or redemption date. So as far as redeemable preference share is concerned, the company or the shareholders, the preference shareholders will be any preference dividend every year, all right, until the redemption date, until the maturity date. So that's the difference between redeemable and irredeemable. Let's say, for example, if a company invested 10 million naira preference share in another company, all right? So the company will be receiving annual fixed dividend. The investors will be receiving annual fixed dividend. Let's say the maturity date is in the next 5 years. So every year for the next 5 years, the company will be paying annual fixed dividend. Then in the final year, which is year 5, the company will also pay back the principal contributed by the investors. This is redeemable preference share. Okay, so let's continue. Preference share can be redeemed at par, premium, or discount. Okay, or discount. So the par value of preference share is quoted at 1 naira. Is quoted at 1 naira. Okay, the par value of preference share is always quoted at 1 naira. Okay, so what this simply means is that if the par value is 1 naira, so a premium means that it will be higher than 1 naira. If it's at a discount, it will be lower than 1 naira. So the benchmark is the par value of 1 naira. All right. Note, our preference share will be redeemable. Only if the redemption dates or maturity dates is given. Okay, it is only when you are given the maturity dates that you are going to treat it as cost of redeemable preference share. Otherwise, it should be treated as cost of irredeemable preference share. So what we are trying to say in essence is that if in a question, when you are given information and you cannot see, you are given information about preference share and you cannot see the examiner call it redeemable preference share, but you cannot see redemption date or maturity date. So it means that you are going to treat it as cost of irredeemable preference share. So that is the treatment. So the cost of irredeemable preference share is calculated as internal rate of return IRR, okay, by assuming two discount rates that will produce two opposing NPV. Two opposing NPVs. All right. So anytime you're asked to calculate cost of redeemable, anytime you're asked to calculate cost of redeemable preference share, simply go ahead and calculate internal rate of return. Whatever you have thereafter is your cost of redeemable preference share. The formula below can be used. Okay, so cost of redeemable preference share, that is internal rate of return, is computed as lower discount rates plus net present value of the lower discount rate over net present value of the lower plus net present value of the higher. All of this multiplied by higher discount rate minus lower discount rate. So this is the formula for calculating internal rate of return, and in effect, the cost of redeemable preference share. Okay. I think I've explained all relevant concepts in relation to cost of redeemable preference share. So at this point, we can have a short example. All right, let's have a short example. Let me stop sharing this. Okay. So go to your study material. We are still on the same page 29, illustration number 5. Illustration number 5. Somebody should read for us. Let me see. Abigail, are you there?
I am here.
Okay, thank you. Read for us.
Page 29. Okay. Question 5, right? Or 6?
Yes, illustration 5.
Okay. Johnson PLC is financed with 1 million redeemable preference shares with a nominal value of 1 naira and nominal rate of 8%, was currently paid at 1 naira 5 kobo ex dividend. The preference share will be redeemed at par in 5 years' time. Required. Calculate the cost of preference shares.
All right, thank you very much. Yes, that is the question. That is the question. Examiner wants you to calculate cost of preference share. What kind of preference share is this one? You need to ask yourself, you need to deduce from the question, is this redeemable or irredeemable preference share? In my explanation, I said that preference share will be redeemable if and only if the redemption date or maturity date is given. In this question, are you given maturity date? Yes, because examiner told you in the last statement that the preference share will be redeemed at par in 5 years' time. 5 years' time is the redemption date, is the maturity date. So now that you have the redemption date, we can calculate cost of redeemable preference share. And I said, to calculate cost of redeemable preference share, what are you supposed to do? Just go ahead and calculate internal rate of return. It's as simple as that. No matter how big is the question, it's the same principle, it's the same concept. Anytime you want to calculate cost of redeemable preference share, just go ahead and calculate internal rate of return. How do you calculate internal rate of return? 2 steps. Step 1, you will assume 2 discount rates that will produce 2 opposing NPV. One discount rate will give you a positive NPV, and then another discount rate will give you a negative NPV. Then step 2, you then use your calculated NPVs to go and compute internal rate of return. That's all you need to do. Anytime you want to calculate cost of redeemable preference share, that's the process, that's the procedure you are supposed to follow. So in this case, let's solve this question. I will stop sharing this. All right, let's move to the working note quickly. That's illustration number 5, page 29. Okay. So the name of the company is Johnson PLC. What do we want to do? We want to calculate cost of redeemable preference share. So you then say calculating cost of redeemable preference share, KP. And I know that calculating cost of redeemable preference share, I will need to assume two discount rates that will produce two opposing NPV, one positive and then negative NPV. Please bear in mind, examiner will know when you are calculating cost of redeemable preference share, don't go and be looking for discount rate to calculate NPV. It is your responsibility. You are the one that will assume the two discount rates to be used, because that's one of the limitation of internal rate of return. It is subjective. Whatever you assume as discount rates is what you are going to use to compute your internal rate of return. So I will then come here. So we need to assume the discount rate. Now, for exam approach, this is what you are supposed to do. Anytime you are computing cost of capital and you want to calculate cost of redeemable preference share or redeemable debts, that is, you want to calculate internal rate of return, always start from 10%. You start your assumption from 10%. So because this will limit your iteration. You know, internal rate of return is a trial and error method. So you will be doing iteration. If the first one does not work, you move to the next one. If the next one does not work, it doesn't align with what you are looking for, you go to the next one. So you keep on doing iteration. That is the internal rate of return calculation. All right. So, but when you start from 10%, if 10% gives you positive NPV, you increase to 15%, right? But if 10% gives you a negative NPV, you can easily reduce to 5%. So that is why I suggested that you should always start from 10%. All right. So now let's solve this quickly. Let's solve. Um, all right. So we are starting with 10%. Now, instead of you to have two different tables for calculating your NPV, you can use only one table because you are going to be using the same cash flow. So why are you having different tables? That will waste your time. So I'm teaching you the exam technique now. So I will then come here. We are going to use only one table for our calculation. So we create a column for year, description of items. We have cash flow. Next is discount factor. Then we are going to have present value. All right, so we are starting with 10% discount rate. So starting from year zero, I will then go to in year zero. This is where you are going to have the current market value of the preference share. And according to the question, we are given SDIF share price to be 1 naira 5 kobo. Okay, SDIF share price is 1 naira 5 kobo. So if I like, I can use par value for my calculation. If I like, I can use absolute value. Whichever one I use, I will still get the same answer. So in this material, I'm going to use par value. All right, I think I use absolute value in the golden book. I will show you later on, but for now, let's use par value so that you see what I'm talking about. So here will be 1.05 cash outflow. Then I will go to the question, what's the maturity date? When are we going to redeem the preference share? Examiner told us in 5 years' time. So which means that the company is going to pay to the preference shareholders annual fixed dividend for the next 5 years. So because the dividend is fixed, then I need to go and calculate annuity factor of year 1 to 5. So here is fixed dividend. Then finally, in year 5, we need to redeem the preference share. Again, I will go back to the question, how are we going to redeem the preference share? Is it going to be redeemed at par, at premium, or at a discount? In the question, examiner told you to be redeemed at par. At par means at 1 naira. Remember, I told you the par value of preference share is 1 naira. Okay? So, but if it's at a premium, it will be more than 1 naira. If it's at a discount, it will be less than 1 naira. So here will be redemption value, which is 1 naira. We are redeeming at par. The fixed dividend, we need to go and calculate the dividend. So this will be for our calculation, then working will be here. Working number 1, I want to calculate fixed dividend. All right. How do I get the fixed dividend? Remember, I told you when I was explaining the concept of preference share, I mentioned to you that the fixed dividend is calculated as the nominal rate on the nominal value. All right. So that's why it is fixed. It's not based on the market price. It is based on the nominal rate. It will be constant. So here will be equal to nominal value multiplied by nominal rate. At times, examiner will not give you the nominal rate. You are going to be given the value of the dividend. So if you are given the value of the dividend, that's fine. But if you are not given, it will be nominal value multiplied by nominal rate. So you understand, based on my explanation, the nominal value is 1 naira. The nominal rate given to us is 8%. So 8% of 1 naira is 8 kobo, 0.08 or 8 kobo. So that is that will go up there. Go and put it down. This is 8 kobo. Now, if I want to use, this is par value. This is what I mean by par value. Let's say, for example, we want to use absolute value. Simple. If I want to use absolute value, all I need to do is to multiply all the par value with the number of shares. Okay? The current market value of 1 naira 5 kobo, I will just multiply with 1 million shares, because according to the question, you are told that the Johnson PLC is financed with 1 million redeemable preference shares. So I will multiply 1 naira 5 kobo with 1 million shares. That will give me 1,050,000 naira. The same thing for the fixed dividend. My fixed dividend is 8 kobo. Sorry, this is 0.08. 0.08. So my dividend per share is 0.08. So all I need to do is to multiply fixed dividend with the number of shares. That will give me 80,000 naira. So that will give me 80,000 naira. Okay. Then the same thing as redemption value. Just multiply with the nominal value of 1 million naira. So that will give us 1 million naira. So that is all you need to do. So at this point, I don't need to determine my discount factor. Okay. Let me complete my table. All right. So at 10%. Now we need to calculate annuity factor of year 1 to 5 at 10%. What do you have there? At this stage, I expected that you know how to calculate annuity factor. If not, I'll just show you. Okay, so let's calculate annuity factor at 10%. Working number 2. The annuity factor is calculated when you have constant cash flow. All right, so when you are given a constant cash flow, instead of you to be doing it one by one, so just calculate annuity factor and you get the same answer. All right, so to calculate annuity factor, AF is equal to 1 minus 1 plus R raised to power minus N, all divided by R. R is equal to discount rate, N is the number of years, okay? So in this case, our annuity factor at 10%, now we assume 10%, so it will be equal to 1 minus 1.10 raised to power minus 5, because our N is 5, maturity date is 5 years time, over R of cost of capital of 10%. So when you put it in your calculator, you get 3.791. So that is that. So I will then come here, 3.791. Discount factor for year 5 at 10% will give us 0.621. Somebody will ask me, how did I get discount factor for year 5? So discount factor at 10% for year 5. For year 5 is calculated as 1 plus R raised to power minus N, which is equal to 1.10 raised to power minus 5. So this will give you 0.621. That's it. So let's go and put it down. So we already have it there. So to now we need to get the present value. 1.05 multiplied by 1 will give us 1.05. Okay? 0.08. 0.08 multiplied by 3.791 equal 0.303. Here is 0.303. Then here will be 0.621. So to get our NPV, we are going to start with the positive present value, which is 0.621 plus 0.303 equal, then minus the cash outflow, 1.05. 1.05 equal minus 0.126. Here is minus 0.126. So we assume 10% and we got a negative NPV of 0.126. So which means we need to assume a lower discount rate that will give us a positive NPV. Therefore, let's assume 5%. So 5% for year 0 is 1. We need to go and calculate annuity factor of year 1 to 5 at 5%. So this will give us 4.329. I've already shown you the example how you are going to do it. So you can calculate that by yourself. Then year 5 discount factor at 5% is 0.784. Okay, 0.784. 1 multiplied by 1.05 will give us 1.05. Okay, then 0.08. 0.08 multiplied by 4.329 equal, that's 0.346. 346. 1 multiplied by 0.784 will give us 0.784. Now find the NPV. So here will be equal to 0.784 plus 0.346 equal, then minus 1.05 equal to 0.08. 0.08. So we assume 10%. We got a negative NPV of 0.126. We then reduced to 5% discount rate and we got a positive NPV of 0.08. Now that we have two opposing NPV, we can then proceed to calculate the cost of redeemable preference share. So KP, cost of redeemable preference share or internal rate of return, is calculated as lower discount rate plus 9 present value of the lower discount rate over 9 present value of the lower discount rate plus 9 present value of the higher discount rate. All of this multiplied by higher discount rate minus lower discount rate. Okay? So cost of redeemable preference share will then be equal to, we assume 5 and 10%. 5% is lower, so our A is equal to 5%. Don't indicate the percentage, just ignore. Then NPV of the 5% is 0.08 over 0.08 plus NPV of the higher 0.126. All of this multiplied by higher discount rate of 10% minus lower discount rate of 5%. Final answer, what do you get? Give me the final answer. 0.08 plus 1.26 equal, then 0.08 divided by answer equal, multiplied by difference between 10 and 5 equal, plus 5 equal. What do you get? Am I on my own? Yes. What's happening?
26.94.
Are you sure?
I'll be 6.9.
26 is not correct. It can't be 26. I lie.
Is it 6.9?
That's 6.9%.
Yeah, 6.9.
So the cost of redeemable preference share of Johnson PLC is approximately 7%. So like I told you, this is the way you are going to do your calculation. You are going to start from the denominator in your calculator. 0.08 plus 0.126 equal. Then you now press 0.08 divided by answer equal, multiply by difference between 10 and 5 equal, plus 5 equal. So that will give you the final answer you are going to put down. All right? So that is the end of the question. So this is how to estimate cost of redeemable preference share. So far, so good. We have dissected the concept of cost of preference share. We talked about cost of irredeemable preference share and the cost of redeemable preference share. On the final note for today, we are going to discuss cost of debt. We still have about 40 minutes, 40 minutes more to go. So let's maximize that so that the faster the pace, the better for us. Okay. Now, let's talk about cost of debt. Cost of debt. Let me, I mentioned to you the other time. In our calculation, I use par value. Yeah. Our current market value, we use par value. Our annual fixed dividend, we also use par value. The redemption value is also par value. And I said that you can either use par value or you use absolute value. So whichever one that you use, you are still going to get the same answer. So let me show you. I think I use in the golden book, I use the absolute value there. So anyone that is more convenient for you is what you should choose. Let me share and just to show you before we move to cost of debt. Let me see. Yeah. Yes, so this is what I mean by absolute value. You can see this is the same question we just solved. All right. So you can see here I use the absolute value. Here I use the absolute value. So all I need to do is to go and calculate the current market value of the preference share, which is 1 naira 5 kobo multiplied by 1 million shares. So that will give me 1,050,000. The fixed dividend also. Dividend is 8%. 8% of the nominal value of 1 naira. So that will give me 8 kobo. 8 kobo multiplied by number of shares of 1 million. That will give me 80,000. All right. The redemption value. The preference share is redeemed at par, which is 1 naira. Therefore, 1 naira multiplied by the 1 million shares, that will give me 1 million naira. So you can see here I use absolute value. Our dividend too is absolute value. All right. Sorry, our net present value is absolute value. So it's the same answer you are going to get. Whether you use absolute value or you use par value, it's the same answer. So this is how I did the workings to arrive at 1,050,000, 80,000, as well as the redemption value. Okay, so that is that. I just want to show you that as promised. Now let's move to discussing cost of debt. After cost of debt, that's where we are going to stop. By the grace of God, in our next class, we start with cost of convertible securities. But for now, let's do cost of debt. Hopefully, the remaining minutes will be sufficient for us to be able to discuss cost of debt. Okay, let me use the working note for the explanation. All right. So cost of debt the cost of debt is the compensation required by the providers of debt. Let me just put it down. This represents the compensation required by the providers of debt capital from their investments in a company. The debt holders are entitled to fixed interest in the firm in the event of liquidation or when a company liquidates, when a company liquidates, the debt holders will be paid before the preference shareholders and ordinary shareholders. It should be noted that debt is a cheaper source of financing. Debt is a cheaper source of financing because of tax deductibility. Because of tax deductibility. All right. So that is that. There are, or you can say debt can be redeemable or irredeemable. Callable or non-callable. All right. So that's that. Now, before we talk about redeemable or irredeemable, let's talk about types of debts. Okay? Let's talk about types of debts. Types of debts. Majorly, there are two types of debts. One, we have traded debts, because anything we are going to be referring to in our calculations will be traded debts mostly, then, of course, non-traded debts. Then number two, non-traded debts. So what do you mean by traded debts? So traded debts are these are fixed income. These are fixed income securities that can be bought or sold in an organized financial market. They are securities that are tradable. Who can give us one example of traded debts? Yes? If you know it, raise your hand. 10 seconds. Give me one example of traded debts. Yes? Examples include what? Okay, because of time. Examples include bonds, debenture, or loan notes. So these are the examples of traded debts. You can buy bonds in the market, you can sell bonds in the market, so they are tradable. All right. Most loans that the federal government usually get are through bonds. Okay. So these are traded debts. These are traded debts. All right. Now, the second part, which is non-traded debts. Non-traded debts. These are securities that cannot be bought or sold in an organized financial markets, just the opposite of the traded. They are securities that are not tradable. Examples are bank loan and overdrafts. Can you take your bank loan to the market to sell? That's not possible. You cannot sell or buy bank loan. It's not possible. Your overdraft facility, you can't give it to another person for use, or you can't sell it to another person. It's also not possible. All right. So these are examples of non-traded debts. So now that you know, let's go back to discussing redeemable and irredeemable debts. So we are starting with irredeemable. Irredeemable debt. So like I said, anytime we are referring to debt, it can either be bond, debenture, loan note, or bank loan. So watch out. What do you mean by irredeemable? The same way you calculated cost of irredeemable preference share and cost of redeemable debt. Sorry, cost of redeemable preference share is the same way you are going to calculate for irredeemable debt and redeemable debt. All right. So the only thing is just that you are changing dividend to interest. That's all. Now, what do you mean by cost of redeemable debt? Irredeemable debt, rather. This is the one in which the company will pay annual fixed interest, but the principal will not be repaid. Okay, that is irredeemable debts. So the cost of irredeemable debts, the cost of irredeemable debts is the ratio of fixed interest to X interest price. Depending on whether or not there is tax or not. Depending on whether or not there is tax. Okay, this is shown in the formula below. Okay. So this is the formula to calculate your cost of irredeemable debts. All right, number A, where there is no tax. Where there is no tax, the cost of irredeemable debts will be computed as the ratio of fixed interest over X int price multiplied by 100%. Then B, where there is tax. Okay, so where there is tax, you need to incorporate the tax elements. So cost of debts, cost of irredeemable debts will be fixed interest multiplied by 1 minus tax rate over X int price multiplied by 100 over 1. So this is the formula for calculating cost of irredeemable debt. Remember what I told you earlier, that debt is a cheaper source of financing because of tax deductibility benefits. Okay? As a result of finance debt capital, the cost that the company will pay will be lower, okay, because of tax deductibility benefits. Now, let's have an example. Let's have a short example to demonstrate this. Okay, let me stop sharing this. Where do you, let's go to your material, illustration number 6. Illustration number 6, still on page 29. Illustration number 6, Aberdeen PLC. Okay. Yes, who is helping us to read? Quickly, who is helping us to read?
Let me read, sir.
Okay, go ahead, Tosin.
Aberdeen PLC is financed with 10 million naira, 9% redeemable debenture, quoted at 102 naira. Interest on debenture was paid last week. What is the cost of debenture if the company is not liable to pay tax? And B, if company tax rate is 40%.
All right, thank you, Tosin. Yes, that is the question. In this question, examiner is asking you to calculate cost of debenture if the company is not liable to pay tax and if tax rate is 40%. So first thing first, you need to identify from the question, what kind of debenture is this one? Is it redeemable debenture or irredeemable? The fact that examiner called it a redeemable debenture does not make it irredeemable. What differentiates redeemable from irredeemable debt is if the redemption date is given. So in this question, you can see examiner call it redeemable, but in this question, are you given any redemption date? No, you are not given the redemption date when when the company will pay back the debenture. All right, it's not, you are not given when the company is going to pay back this 10 million naira. All right, so since you are not given the redemption date, then you are going to calculate as cost of irredeemable debt. And I said that the cost of irredeemable debt is the ratio of fixed interest to X int price. So let me switch to the working note quickly. Okay. Solution to illustration number 6. Still on page, I think 29. All right. The name of this company is Aberdeen PLC. You are now asked to calculate cost of debenture. You are to calculate cost of debenture. We have identified from the question that this is irredeemable. Why? Because the redemption date is not given in the question. Therefore, you are going to calculate cost of irredeemable debenture. So I will then come here, calculating cost of irredeemable debenture. Debenture is a form of debt. Okay. So, examiner told us number one, where there is no tax. So, where there is no tax. So, if there is no tax, then cost of irredeemable debt is computed as the ratio of fixed interest over X int price. X int price multiplied by 100 over 1. You can see the denominator. I called it X int price. So again, if the interest has not been paid, it means that the market price of the debt is cum int. So you need to convert the cum int to X int price before you can calculate your cost of debt. All right. So KD will then be equal to, I will go to the question. What is the coupon rate given to us? Coupon rate is the same thing as interest rate. So the coupon rate is 9%. I think I mentioned, I don't know if I mentioned to you before, debt is always quoted at 100 naira per unit. Let me put it down for you. Let me go back to our notes. Let me just put it somewhere here. Notes. Debt is always quoted at 100 naira per unit. So just like preference share is quoted at 1 naira nominal value. So the same thing here, debt is quoted at 100 naira, except examiner says otherwise. At times, examiner can ask you, or you will be given that debt is quoted at 1,000 naira. So whichever way, just know what to do. All right. So that's that. Then let's continue. So the interest rate is 9%. So just put 9 here. Forget about the percentage because 9% of 100 naira will give you 9. Will give you 9 naira. So always ignore the percentage. All right. So this is 9 over the X int price. I will go back to the question. What's the market price of the debenture? We are told that the debenture, we have redeemable debenture quoted at 102 naira. 102 naira is the market price. So here will be 102, 102, then multiply by 100 over 1. This will give you approximately 9%. Okay, this will give you approximately 9%. The cost of irredeemable debenture of Aberdeen PLC is approximately 9%. Then number B or number high, number 2, where there is tax, of 40%, we are given tax rate of 40%. So where you are given tax, you need to incorporate the element of tax in your calculation. So cost of irredeemable debenture will be computed as fixed interest multiplied by 1 minus tax rates over X int price multiplied by 100 over 1. The interest rate is 9%. So the interest that the company will pay is 9% of 100 naira, which is 9 naira, multiplied by the tax rate is 40%. So that will be 1 minus 40% divided by the X int price is 102 naira, multiplied by 100%. So KD would then be equal to 9 multiplied by 0.06. Ruth, you are writing on my screen. Stop it. Zero 0.60 divided by 102 multiplied by 100%. 100 over 1. Therefore, the cost of irredeemable debenture where there is tax is equal to 9 multiplied by 0.6 equal divided by 102 equal multiplied by 100% equal 5.29. That's approximately 5%. That's 5%. You see what I was telling you the other time, that debt is a cheaper source of financing because of tax deductibility benefits. You will notice that in the first calculation that we did, where there was no tax, the cost that the company will pay is 9%. Where there is tax, the company will only pay 5%. So because of tax, there is a benefit that the company will earn as a result of that. So this is how to calculate cost of irredeemable debt. Finally, let me explain the cost of redeemable debt, and that will be the end of today's class. Ruth, this is your mark. Let me stop sharing this and share again to remove your handwriting on my screen. Okay. So, redeemable, or just say cost of redeemable debts. Okay, so what do you mean by redeemable debts? Redeemable debts is the one in which the company will pay annual fixed interest and the principal at the maturity date. Okay, so just like you have the cost of redeemable preference share, debts can be redeemed at par, premium, or discounts. The par value of debts is always quoted. I think I've mentioned this previously. It's always quoted at 100 naira per unit. So what this simply means is that if it's at a discount, it will be less than, that means it is quoted below the par value. If it's at a premium, it will be higher than 100 naira. Okay? So that is that. Note, debts will be redeemable. Only if the redemption dates is provided or given. If not, it will be calculated as cost of irredeemable debts. Okay, as cost of irredeemable debts. So the cost of redeemable debts is calculated as internal rate of return. Just as explained under the redeemable preference share. So all my explanation under the redeemable preference share is the same thing here. You assume two discount rate that will produce two opposing NPV. You then use your calculated NPVs to estimate the cost of redeemable debt. That's all you need to do. All right? That's all you need to do. And if you can spare me additional 5 minutes, we can use that one to solve a short example so that in our next class, we know that we are just calculating we are starting cost of convertible securities. Okay? What happened to you, Moses? Are you crying or you are laughing? or both?
I'm tired.
You are tired?
I'm
Okay.
tired.
Oh, yeah. Okay, then let's call it a day. All right?
Thank you.
It's all right. Okay, my people, let me know if you have any question for me so that we can close the class. I know some of you have disappeared, but I still have some patients and the committed ones waiting behind. I can still see Laura. I can see Sharafa, Akko, David, Oluwatosin, Temitope, Elizabeth, Clement. Then I can see Ruth. Okay, Oluwabukola is still on. Usman. Okay, I can see Michael. I can see Dorcas. Faith is still on, standing on. Gidigba. David is also on. No worries. Others have disappeared. It's okay. I understand. Can you please share the material on the group again? No worries. I will share almost immediately. All right. Let me know if you have any question for me, so that we can close the class. Okay. Any question? All
No
right.
question. It's just to thank you for the way you are simplifying this topic for us.
All right. Thank you. You're welcome. All right. So in the absence of no further question, I wish every one of you a restful night. We meet again next week, Tuesday, by the grace of God, when we shall be solving a short example on the cost of redeemable debt. Then thereafter, we are going to do cost of convertible securities. So if you still have time on that day, then I will introduce you to weighted average cost of capital. Okay, so good night, everyone. I will see you next week by the grace of God. Bye bye.
Good night, sir.
Thank you,
Thank you.
sir.
You're welcome.